Well, look, good afternoon. Welcome to this LKY School public lecture. We're very fortunate this afternoon to have Klaus Regling, who's going to be talking about Europe's response to the crisis. And clearly, this is a very topical issue at this period of time. Let me just very briefly say something about Klaus's background. You may know that at the moment Klaus is Chief Executive Officer of the European Financial Stability Facility. He's had this position since, I guess, July this year. Klaus has a long and distinguished career in the public and in the private sectors. Let me just note, in terms of his public sector roles, he spent almost a decade in Washington working at the IMF, and he had a posting in Indonesia as well. He spent time at the German Ministry of Finance, and between 2001-2008, he was Director General for Economic and Financial Affairs at the European Commission. I should also note that Klaus was the European Union Fellow here a short while back. He spent a year or so at the LKY School. We're very fortunate to have him make the time to come and talk this afternoon. And Klaus has indicated, I think, that he'll speak for maybe around 30 minutes or so, and after that time we'll open the floor to questions. So Klaus, thank you very much.
Thank you, Charles. It's a great pleasure to be back here at the Kuan Yew School. I have fond memories when I spent here a year. Seems a long time ago, although it was only a year and a half ago. And certainly my life was a little bit quieter here than it is at the moment. So maybe I can come back after I have done this job. I would certainly need another sabbatical then. So I'm here to talk about Europe. And you may be wondering what's happening in Europe, because when you read newspapers and watch TV, you may get the idea that Europe is in chaos, disintegrating, that the euro might disappear. But all this is wrong. When you look at the real economy, growth forecasts for Europe have actually been revised up in recent months, unlike forecasts for the United States, for instance. Of course, we have problems in Europe. There is continued uncertainty and tensions in the sovereign debt markets, in financial markets. But Europe has taken action this year to tackle these sovereign debt issues. And Europe has shown that it is serious about the protection of the euro. That message, I think, can easily be missed in the midst of all the excitement about crisis management and rescues of Greece and Ireland. Therefore, the main message I want to convey to you today is that European governments have done a great deal this year to put structures and policies in place to address the problems that accumulated during the first decade of economic and monetary union. And these problems became more visible during the crisis, but they are being addressed. For instance, fiscal exit and fiscal consolidation strategies are in place for all EU member states. Countries which lost competitiveness are now working to correct their problems, and there are clear signals that the correction is taking place. The structural reform agenda is implemented in all EU member states. Decisions to strengthen financial market supervision have been adopted. There are concrete proposals on the table how to improve policy coordination in the euro area and also surveillance. And last but not least, the financial crisis mechanism was put in place. And it was also decided last Sunday to make this mechanism permanent as of 2013. So this is a long list of things, certainly more than people expected could be done about a year ago. And I will talk about the main elements in a moment. But let me first take a quick look at the economy. The crisis hit Europe like many other parts of the world in a significant way. GDP dropped by 4% in 2009, and industrial production went back to the levels of 1990. But then the economy stabilized in 2009. You see the growth figures here. And as I mentioned, growth forecasts have been revised up by everybody. The Commission came out with a forecast this week, Monday. The IMF, in its forecast of October, already revised up for this year. Growth would then slow down again in 2011 and 12, but stay at levels that are more or less in line with the euro area's potential growth rate. And monthly data and frequent data that come out every week are positive. On Monday, for instance, new consumer investor confidence numbers came out for the euro area and for the EU and reached a 5-year high. All this is not recognized widely. You don't read about it in the newspapers because everybody is focusing on financial markets, but this is the real economy that is doing rather well. So I would say there's a disconnect between what's happening in the real economy and what's happening in financial markets. And certainly the concerns that people expressed a few months ago that Europe would be the laggard in the global economy with respect to growth and that there might be a double dip, that's certainly not happening, not materializing. Also, one footnote in this context, when you look at GDP growth rates in Europe and you read numbers about growth, you often have the idea that these growth rates are not very high. But one has to look at GDP per capita growth to get a real understanding of how standard of livings are developing in Europe, because the population in Europe is stagnating. It will begin to fall in a few years. In some countries like Germany, it has been falling already for the last 3 years. And if we translate GDP headline growth figures into GDP per capita growth, you see that the euro area is not doing so badly. The last 10 or the last 15 years, GDP per capita growth in the euro area was the same as in the United States. That's not what the idea you get when you read the press, where I see permanent complaints that Europe is falling behind. It's just not true. Standard of living is measured by GDP per capita growth, not by headline growth. And that's a number that's relevant for policy making. When we try to understand what's happening in the economy in Europe during the crisis and this year, one has to realize that there was really a strong collective policy response to the crisis in Europe. The table is maybe a bit dense, but it reflects the reality that there was action in the different areas. I assume these slides will be published on the website of the school, so you can check the details later. But for instance, on the fiscal side, there was fiscal stimulus in 2009 and 2010, equivalent to around 5% of GDP, which is about the same as in the United States. This was a combination of discretionary fiscal action and the automatic stabilizers, which are very sizable in Europe. On the monetary policy side, on both sides of the Atlantic, interest rates were pushed down close to zero. And when you look at the balance sheet of the Fed and the ECB, it's interesting that both expanded by about 10% of GDP. So also a very comparable development. In Europe, the financial crisis exposed some of the gaps and weaknesses that had accumulated during the first decade of EMU, and not only in the financial sector. loss of competitiveness and large current account imbalances aggravated the vulnerability of some European countries to the financial crisis. Obviously, the fiscal impact of the crisis was particularly visible in countries where real estate bubbles had led to temporary increases in revenue because housing and construction activities are always very tax rich and produced huge tax windfalls. And then on top of that, we see large contingent liabilities in the context of the rescue of financial institutions in several euro area member states. And these data show that some countries were not well prepared and went into the crisis with deficits and debt levels that were too high. This slide shows what happened to the debt levels and the structural balances for individual euro area member states in the crisis. And you see that when you try to look at the details, that the positions differ a lot across the euro area, and that is leading to some problems. But debt ratios, of course, went up in many countries around the world, particularly in the industrialized world. And this shows how debt ratios changed and what the debt level was in 2007 and what is the projected change since then. And you see that in some countries outside Europe, the changes are even more pronounced than in Europe. But when we try to analyze what's going on now in financial markets and on the sovereign debt side, the turbulences that we see do not only reflect deteriorating fundamentals, the growing imbalances, and the, in some cases, strained fiscal sustainability. It also reflects a change in market behavior. Financial markets failed before the crisis, and I think we see a failure again now. Before the crisis, and even until the middle of 2008, in general, risk spreads were too narrow. They did not adequately reflect the underlying risk. This is true for many assets, but it was also true in Europe when we compare the risk spreads in different bond markets. For instance, Greek 10-year government bonds until October 2009, so only 13, 14 months ago, were only 30 basis points above Germany's 10-year government bonds. This was a market failure. Risk spreads were too low. And now we see that risk spreads, in my view, have become too high. So market behavior has changed in the opposite direction. We know that markets tend to overshoot then when they go through adjustments. There's herd behavior, and all that leads from one extreme, too low risk spreads, to too high risk spreads that we are seeing at the moment. This shows a little bit what happened in the financial markets in Europe over the last few months, since early this year. And some of these moves are very hard to explain by economic factors. For instance, there was a spike in spreads and a drying up of markets right after the tough adjustment program for Greece was announced, which should have improved the assessment of markets vis-à-vis Greece. But I think at the moment we see clearly a flight to safety in Europe. So Germany is benefiting from developments. Markets are very thin. Not much trading is going on in the periphery bond markets of Southern Europe and Ireland. And therefore, one has to be very cautious to interpret recent market developments as a reflection of actual default risk. And both the IMF and the OECD have argued, they have put out reports that the default risk implied by market developments in Europe is exaggerated. And I think in any case, the volatility of these headline risk indicators tend to overshadow the real progress which we see in the European integration process, its governance, and in the financial market architecture. And I want to talk a little bit about that. We see progress in regulatory reform, which will lead to better functioning of European financial markets. We see progress in governance reform, and we see progress in the crisis management approach. Let me talk about these three topics for a few minutes. On the regulatory side, Europe has implemented a number of reforms in recent months. Decisions have been taken, there is agreement, and the implementation will follow now. First, a European Systemic Risk Board will start its work on the 1st of January next year. This risk board will be in charge of macroprudential supervision, which is something that was ignored before the crisis. Typically, supervisors, regulators focused on micro risks. They looked through the loan book of banks and assessed whether the loan book had high risks or low risks or was okay. But there was nobody who added up all the numbers to get a macro picture of the macro risks. This is certainly one lesson of the crisis, that this must be done, should be done in the future. Not only in Europe, other countries are doing the same thing. The United States is also creating a new body that will be in charge of macroprudential supervision. In addition, in the EU, we have created 3 new supervisory institutions to supervise banking, insurances, and securities markets. These new institutions will get real power, particularly in a crisis, where they can intervene in national markets. And this represents a real transfer of additional sovereignty from the national level to the European level. And this is really an interesting development because this new supervisory structure is the first supranational one in the world. And it shows that the member states of the EU are willing to take necessary steps and to transfer sovereignty when it's really necessary. In general, there's a reluctance to do it, but when it's really necessary, as the crisis made clear, they are willing to do that. In addition, there is a number of other regulatory initiatives in Europe, but also, of course, around the world, discussed and agreed in the context of the G20 and the Financial Stability Board on how to deal with derivatives and centralized clearing, to strengthen capital requirements, to impose more transparency requirements on hedge funds, and so on. But these are, in principle, global issues where Europe participates actively. These items are important, but they are not the end. Further reforms will be needed, and in Europe, the European Commission has just proposed compulsory clearing of derivatives, because derivatives markets do lack transparency. And I already talked about capital requirements and so on. So this was the first point on regulatory reform. In the area of economic governance, we have learned through the crisis that we need to do better. The weaknesses that we have in the governance of the euro area were already clear a few years ago. And I remember, because at that time I was still working in the European Commission, we put out a big study in the middle of 2008 that talked about the successes of the euro during the first decade of EMU. But the second half of that study talked about the gaps and weaknesses. We didn't know at the time that these gaps and weaknesses would become so big and would affect financial market behavior so much, but they were actually identified some time ago. And we know now through the crisis that we have to work quickly on these. When I talk about economic governance, it really means two areas. One is related to fiscal coordination, where we have the Stability and Growth Pact that coordinates the fiscal policy that's implemented at the national level. And the second aspect is economic surveillance. These need to be improved. And then the basic design of EMU, which is centralized monetary policy and one exchange rate, obviously, combined with decentralized fiscal policies and decentralized structural policies, this basic design can work. But it requires better coordination than in the past. Therefore, we are working on these areas. The Stability and Growth Pact will be strengthened. There will be tighter rules in different parts of the pact. Sanctions will be imposed earlier and faster. Also in the so-called preventive arm of the pact, which is the area when a country has a deficit below 3% of GDP, but is not in balance. There will also be a framework now how to deal with that part. We always had a framework how to deal with countries that had deficits above 3%. So this preventive arm will be strengthened, which is important in order to prevent crisis. There will also be more focus on debt levels. There's also an effort to implement in national legislation budgetary frameworks. Germany did this. It's now in the German constitution. There are provisions that reflect more or less what's at the European level done through the Stability and Growth Pact. There will be more ownership if all countries do move in that direction. There have also been moves to improve the statistics. As you probably know, Greece surprised us several times by coming out with higher deficits. So obviously there was something wrong. This is now corrected, and one lesson of the crisis, together with many other lessons from the crisis, is that Eurostat, which is the statistical body of the European Union, will get more powers, has now obtained more powers to check the data at the national level. And then there will be a framework established, which didn't exist before, to do better economic surveillance. The objective here is to identify early on excessive macroeconomic imbalances, for instance, current account imbalances, deviations in unit labor cost, a framework to discover these imbalances and to follow up, because obviously these kind of developments were also discussed in the past. In the monthly meetings of the Euro area finance ministers, there was always a discussion on economic developments, on the main trends, but there was no framework. That means there was no recommendation given to countries, no follow-up to check whether a country would comply with these recommendations. All that is being created now, and there will even be sanctions for countries that don't follow these recommendations. So these are important lessons from the crisis. The discussion is quite advanced in this area. The Commission has made proposals. The Council had some discussions. The European Parliament, which since the Lisbon Treaty became effective, has to also agree to these changes, wants to be even more ambitious than the Council. So there's an interesting debate going on between Parliament, Council and Commission. We don't know the exact outcome, but it's very clear already today that there will be progress. The Stability and Growth Pact will be strengthened, and there will be a surveillance framework. The third component of the European crisis response is the development of several crisis resolution mechanisms where some real money is available to help countries overcome the crisis. On the left-hand side, you see the so-called balance of payments facility, 50 billion euro. This facility, balance of payments facility, has existed for a long time in the EU, since the 70s actually, but it was quadrupled from 12 to 50 billion in the context of the crisis in 2008 and 2009. This facility is reserved for non-euro area countries. So countries, you may know, the EU has 27 member states, the euro area has 16. So for the 11 countries that are in the EU but not in the euro area, this money is available, and it's actually being used at the moment by Hungary, Latvia and Romania, where programs are in place in cooperation with the International Monetary Fund. Then there was the Greek program it's not mentioned on the slide, but Greece received a support package of 110 billion euro in April this year. This was done before the EFSF was created, a joint program between European countries and the IMF. And then in May this year, a 750 billion support package for euro area countries was created with three components: 60 billion euro managed by the European Commission, called European Financial Stabilization Mechanism, 440 billion, these are guarantees from the 16 member states of the euro area that guarantee the activities of the European Financial Stability Facility, EFSF, and the IMF made the commitment to add 50% of what the Europeans are doing, so that could go as high as 250 billion. When this package was created, also it was announced by the ECB that they would intervene in the sovereign bond market if and when necessary. Assistance provided by the EFSF, the EFSM and the IMF is linked to strict policy conditionality, which means loans to a country will be accompanied by a detailed and demanding set of policy conditions as we know them from traditional IMF programs. And Asia has some experience in this respect and often criticized even up to today how tough these conditions were. I think when these are compared with what's happening at the moment in Greece and Ireland, one can come to the conclusion that it's even tougher now in Europe. But like in Asia, where these policy conditions in, for instance, Korea, Indonesia and Thailand, which were tough, not popular, but I think one can argue that these policy conditions led to better economic developments subsequently, and we are all aware of the good economic performance of Indonesia and Korea in recent years. I think that has something to do with these tough conditions that were imposed in the late 90s. And I am confident that we will see the same happening in Europe, that the countries that are willing to undergo these tough policy conditions will also have a better economic performance in the future. The EFSF became fully operational in early August when all the legal things had been done and all the commitments from the 16 member states had been ratified by their respective parliaments. Since then, the EFSF has received a top credit rating from all the major rating agencies. This AAA rating is based on the support from the member states, the guarantees we receive, and we have a few provisions also in place, like cash reserves, that made it possible to obtain this AAA rating, which is important when we go to the markets, which will happen now soon. Although we have a big amount, 440 billion, that is behind the EFSF, we are a very small, lean institution with a staff of only about 1 dozen. What do you expect when 16 finance ministers are your boss? We can be so small and still we're able to become operational very quickly because I rely on the help of two big, well-established institutions. The German Debt Office, Deutsche Finanzagentur, is like the front office of the EFSF operation. They will raise funds. They will issue bonds on behalf of the EFSF. They will continue, obviously, to do their work for the German government, but the EFSF will be their second client. And the European Investment Bank, which is our neighbor in Luxembourg, is doing a little bit of the back office work. We share the same IT system. They help on the accounting and so on. So given the help of these institutions, it was possible to keep the size of the EFSF itself very small in terms of staff. The European Central Bank is our paying agent, so we have our accounts there. So they're also doing their share. When the EFSF was created, of course, the hope was that it would never be used, that it would not be needed to activate it, that the fact that it was there would be sufficient to impress markets. Unfortunately, this is no longer the situation. As you are aware, finance ministers of the euro area decided last Sunday, so only 3 or 4 days ago, to accept the request from Ireland for financial assistance. Ireland, therefore, will undergo a program over a 3-year period. The objectives of the program are to reduce the size of the banking sector, to restructure the banking sector. Ireland had by far the largest banking sector in terms of GDP of any EU country. Not as bad as Iceland, but the biggest in the EU. The second objective of the program is to reduce the fiscal deficit and to restore fiscal sustainability. It's foreseen that the fiscal deficit will fall below 3% of GDP by 2015. And the third objective is, of course, to get growth going again in Ireland. So Ireland will undertake structural reforms, labor market reforms, in order to return to sustainable growth. This will be supported by a program of 85 billion euro. 17.5 billion of that will come from a reserve fund that exists in Ireland itself. So the external support is 67.5 billion euro. And this 67.5 billion euro is split between 1/3 coming from the IMF, which is in line with what I explained earlier, that they add 50% to what the Europeans do. 1/3 will come from the EFSM, which is the 60 billion pot managed by the European Commission. And 1/3 will come from the EFSF and from bilateral loans from non-Euro area countries. It's quite interesting that the United Kingdom, Sweden, and Denmark have agreed to participate in this rescue effort, which shows that it's not only Euro area countries that are concerned and are willing to put guarantees behind the Irish program, but also countries that are in the EU but not in the Euro area. These amounts, the 67.5 billion, will be dispersed over the next 3 years. The average loan maturity will be 7.5 years, and the EFSF will issue its first bonds in January next year. It's also interesting that last Sunday, first decisions were taken on a permanent crisis mechanism, because the EFSF was created as a temporary crisis mechanism, which would normally close its doors in 2013. Of course, to the extent that we issue bonds, which we will do now, we would exist as long as it takes to repay all obligations. But the idea was that only till June 2013 we would enter new programs. So now it's clear that the European Stability Mechanism, a new acronym, I also have to still get used to it, ESM, will evolve out of the EFSF in the middle of 2013. On the funding and lending side, the ESM will be very much like the EFSF. But the big difference is that from mid-2013, we will have a framework in which it is in which private sector involvement is organized. Because there's a widespread feeling, not only in Europe, that private creditors have to be involved when a country gets into trouble. Otherwise, there would be a moral hazard problem if only public sector is used to help a country. But it is important that it was decided on Sunday that this private sector involvement will be done on a case-by-case basis. The debt sustainability analysis will be done by the Commission, the IMF, and the ECB. And then it will be decided whether the country faces a liquidity problem or a solvency problem. All this is in line with established IMF policies. This is important, was important to say loud and clearly by the euro area, because financial markets were afraid that they would always be asked to do debt reduction in any involvement in a crisis resolution. Now it's clear that will be determined depending on the special case, whether it's a liquidity problem when debt reduction is not needed. If it's a solvency problem, then the private sector will be asked to contribute to debt reduction in order to reach sustainability again. But in that context, it's important to realize that no advanced or industrialized economy had any debt reduction or any default since World War II. So this is really a rare occasion and will continue to be a rare occasion, while liquidity problems can happen from time to time. And then it is important to have mechanisms in place to address those temporary liquidity problems. Collective action clauses will be introduced in all euro area government bonds from June 2013, which will allow it to involve the private sector, not immediately, because these collective action clauses will be introduced whenever new bonds are issued. Old bonds obviously don't have them, so it will take a number of years before all this can become operational. There will also be a small change in the EU treaty to make all this possible. So let me sum up. I talked about the economic situation, which seems to be disconnected from what's happening in financial markets. Apart from that, we are in a process to improve the functioning of financial markets, to strengthen governance, to create crisis mechanisms also on a permanent basis. So the common theme underlying these different initiatives is that we will have more Europe in the future, not less. That's really the response of Europe to the crisis, to integrate more in areas where it's needed for a better functioning of monetary union. We see it in the regulatory area, where there's a real additional transfer of sovereignty. We see it in the governance area, where there will be stricter fiscal coordination rules. We see it in crisis management, where member states agree to have a permanent mechanism after now having a temporary crisis mechanism, the EFSF. So there is really progress towards more Europe in all these areas. And I think in a few years, when we look back at this crisis, we will again conclude what we concluded several times in the past, that a crisis was a golden opportunity to make progress in European integration. When you're in the middle of the crisis, it often looks hopeless, but it is the moment to do more, and we see that more is happening in these different areas, and I think that's exactly what is happening again now. Thank you.
Thank you very much, Klaus, for that very optimistic note in terms of the opportunities. Realistic note in terms of the forward-looking issues in Europe. Before I hand over for questions, let me just ask something about this disconnect between the real economy and the financial side, particularly, I guess, the capital markets. And I guess my question gets to the conditions of European banks and the exposures of the banks at the core to some of these countries in the periphery. My understanding in the case of Ireland is that the program goes along with most of the private liabilities being absorbed by the Irish state and then eventually back through the program. Is that a sort of inevitable consequence of the degree of uncertainty at the moment? Because one might argue that some degree of private sector involvement this time around could set the seeds for some of the things you're discussing in the future.
Yes, no, that was an important question that was discussed intensely in recent weeks and months. Already in the case of Greece in April, how to deal with that, and now in the case of Ireland. The problem, so to say, is that when the crisis started or intensified after Lehman in September 2008, Ireland gave a blanket guarantee for all bank liabilities, almost all. And therefore, if one were to impose now solutions on the private sector, it really means that the Irish government's obligations would be affected. And in general, that was thought to be unacceptable under the circumstances, particularly given the fragility of the current situation. Now, there are some elements of Irish banks' obligations that are not covered by the guarantee. You may have seen that there were haircuts imposed on the so-called junior debt of one of the big banks, and it was actually a haircut of 80%. And there are still outstanding obligations of this type of junior debt not covered by the government guarantee in Ireland, which amount to about 6% of GDP, and they will also be treated in a similar way. So there's some kind of PSI, as we IMF people used to say, private sector involvement, but it's relatively small compared to the overall size of the Irish banking system. To tackle senior debt guaranteed by the Irish government, I think would be rather unwise. The Financial Times is recommending it every day, it seems. Our judgment in Europe was just too risky. It reminds me of the Financial Times recommendation the Friday before the Lehman collapse, that it was time to let a big bank go. We didn't want to take that risk.
Can I open up for questions? At the back here? If you could give your name and affiliation.
My name is Saurabh Roy, and this is just continuing the discussion that we just had about the disconnect between the real economy and the financial economy. And as we saw in your presentation, that the European Financial Stability Facility will be able to borrow over 440 billion euros to lend to struggling Eurozone countries. And in turn, the borrowings will be guaranteed by other Eurozone countries. In terms of Germany, it's known that it's on the hook for around 150 billion euros, and that's using a lot of public money at a time when the German economy is just about to spring back. There's also a growing perception back in Germany that it's unwillingly playing the role of the paymaster of the crisis in failing European economies. How do you react to that? And if that is not true, then how does Germany, which is just springing back from the failing economy and the crisis, gain from its contributions to the guarantees and to the bailouts?
Yeah, you're right. The mood in Germany is not good on this, but this is to a large extent because the public is not well informed and does not fully understand what's happening. There's a widespread feeling also among my friends in Germany that the German taxpayer is paying tens of billions to Greece and now to Ireland. They think these are grants, fiscal transfers. But that's not the case. These are loans, as I explained. They have to be repaid. And actually the interest rates that Ireland will have to pay, the interest rates that Greece has to pay, is higher than the funding cost. So there's actually a profit which will be distributed to the guarantors of this operation. So the probability of Germany, like the other countries, making a profit out of this is higher than the probability of a loss. That's what I see our colleague from the Frankfurt Allgemeine shaking his head. But I explain it also a lot to German journalists who are surprised, and others. I had a Dutch journalist in my office 2 days ago They have not looked at it that way, but that's how it operates. Countries that guarantee the operation get a premium for their guarantee, which is normal. If a bank makes a guarantee, they get a premium. If everything goes according to plan, there will be a profit. Of course, one cannot argue that the risk is zero, that not everything goes according to plan. But as I said earlier, no industrialized country has defaulted since World War II, so that is rather unlikely. So to some extent, one has to explain better that Germany is not the paymaster. It's not only Germany, also public perception in the Netherlands and Finland, some other countries is like that. Clearly, and that's why the German government, despite the public opposition, has agreed to all these operations, is the analysis is clear that this is in Germany's interest. In several respects, it's in Germany's interest and in the interest of all euro area countries to maintain financial stability in the euro area. It's in everybody's interest to maintain the euro. That's beyond any doubt anyway. The euro has been a big success during its first decade. The crisis showed this particularly strongly, and it's in the interest, in the economic interest of weak countries who would have to pay much, much higher interest on their public debt. But the euro is also in the interest of the strong countries like Germany, the Netherlands, Austria, Finland. So they have the same interest, the weak and the strong countries, so nobody thinks about giving it up, despite good advice we always get from famous Anglo-Saxon professors in this respect. And that's the economic argument. And then there's a political argument that the euro is the highest level of European integration, and nobody wants to reverse that. So, and finally, when you look at Germany, German banks are heavily engaged in countries like Greece and Ireland. Not surprising, because Germany is the biggest economy in Europe, so German banks are active everywhere. And it will help them when financial stability in the euro area is maintained. So there are many good arguments to do all this. What is missing a bit is better communication.
Thank you. A question over here?
Thank you very much. My name is Moller, and I work for the Institute of Southeast Asian Studies. And first of all, thank you very much for a very clear expose. And I noticed that you actually said on the sideline, if I may say so, that almost all of the problems we now encounter in Europe, they were actually foreseen when we created the euro. And we expected that there would be problems, but we didn't tackle them in the way which we now have to do because of the crisis. And that, as you said, would unquestionably lead to a high degree of integration. But my question is, you very clearly explained how the real economy in Europe is improving, and that should, if the financial institutions act rationally, lead to a lower spread risk, while in fact it is leading, or at the same time as we see this, the spread risk is growing. And that leads to the question, why is that happening? And I suspect a little bit like the former question, and your answer to that, that is because the financial institutions, which, if I may allow myself to say so as a European, are primarily American and British banks. They see a profit booming if they can generate a crisis, and they actually pursue an active policy generating a crisis, not because of political motives, but because it gives them a profit opportunity. And my question is, do you agree with that? And if so, are there any actions we can take so that the banks would not get the profit, and that they would not operate in an environment where there is a profit opportunity but no risk-taking for them?
On your first point, we did not foresee the problems and the gaps when we created monetary union, because then we should have fixed it right away. But what I try to say is that during the first decade of EMU, certain gaps, weaknesses became visible, which is in a way not surprising because the creation of monetary union in Europe is a huge project, unique. It had never happened before, really. And it would have been unrealistic to expect that everything would be perfect from the beginning. I think one has to accept that. It was just too big a project. And therefore, it's necessary to draw lessons, see where we need further improvements. And what I said is that in 2008, when the European Commission put out a big study, that's where we clearly identified some of the areas that are now being tackled. The readiness of member states to tackle these issues earlier were a bit underdeveloped, and the crisis sharpened the focus and made it clearer to everybody that these indeed were areas that needed to be tackled. So, but your real question was on the behavior of financial markets. And this is a difficult area, and one has to be careful because it's not appropriate to blame it all on speculators. To some extent, we see a structural adjustment in financial market behavior. They were too complacent until 2008, and I gave the Greek example of risk spreads of only 30 basis points until October 2009, so until very recently, they underpriced risks. And then there was something triggered an adjustment, and we can identify what, because we saw the Greek situation, data were corrected, deficits all of a sudden were much higher, so markets reacted. But when markets come from a situation that is really wrong and complacent for a long time and go to a new equilibrium, they always overshoot, so they go to the other extreme. And that, when that happens, there can be contagion to other countries. It's very hard to say how long it lasts. It will correct eventually, but I think we are still now in this phase of overshooting. And when that happens, uncertainty is created in the markets. And then institutional investors, long-term investors, that are certainly not speculators, like pension funds, life insurances, they say, oh, this is now so uncertain, we better wait a bit. And that's what we see at the moment. Big investors, very serious long-term investors, like, let me not give any names, but let's say life insurances, who certainly have a long time investment horizon, say, well, we better wait a few months and before we buy again Irish or Portuguese government bonds. We can invest in the meanwhile somewhere else. But if everybody takes that view, if nobody really buys, the market gets very thin, and then if just a few people sell or a few speculators get into the picture and do forward sales or buy CDS, then there's a big impact, and it goes a long way in the wrong direction. That's where we are at the moment. What one can do is what we try to do in Europe. One is to help the countries, giving them financing, so that, like now in the case of Ireland will not need to go to the financial market for 2 years. When the Greek package was adopted in April, Greece since then has 3 years' time before they need to go back to the market, so that's one step. It only buys time, this action. Like any IMF loan only buys time, and this time must be used by the country that receives the financial assistance to bring its house in order. Takes the necessary economic policy adjustments on the fiscal side, on the structural reform side, so that the fundamentals improve and competitiveness returns. So that's what we are doing now. I'm convinced it will help. But at the moment, the markets are so tense, so much in a crisis mode, so much overshooting, it's very hard to predict how long it will last.
A question over here.
Thank you. My name is Saul Iglesias from the Asia Europe Foundation. Could you comment on the impact of current developments on the Eurozone itself? Do you foresee that new entrants into the Eurozone will I mean, whether or not there will be new countries adopting the euro, and also conversely, would there be some countries in danger of dropping out of the Eurozone?
Hi, Sol. I was hoping to see you. The euro area will continue to grow. This is very clear. It will actually grow in January, so in 1 month from today, because Estonia will join as the 17th member. All the preparations have been done. They met all the entrance criteria. So there will be 17 from next year. And after that, more countries will join. We don't know exactly when. You know that there is certain criteria have to be met related to public debt, fiscal deficits, interest rate levels, inflation rates. And only if these criteria are met is a country allowed to join. I expect that most of the 11 countries that are in the EU but not in the euro area yet will join over the next 10 years. Probably not all. The UK is very unlikely to join, I think, but probably most of the others within a decade or so. And then the EU will grow. Croatia may become the 28th member. And so when this happens, these countries will also be eligible to join the euro area one day. Not immediately. They also have to meet the criteria. So definitely the euro area will grow. There's no country in the euro area that has any intention of leaving. I already gave the economic and political arguments why it's in nobody's interest to do that. And it's also very clear when I travel to the countries that are now particularly affected by the crisis, like Greece or Ireland, where the population really suffers. They have real income cuts, fall in standard of living, tax increases, increases in retirement age. Nobody wants to leave the euro area. They all are convinced that it helps them to get through the crisis, that it would be worse without the euro, and they want to be part of the European integration story. So there's no, apart from a few very small minorities, there's no movement, even in these countries that are very hard hit by the crisis, to leave.
Question?
Yeah.
Sorry, can you say it again? That Eastern Europe?
Eastern Europe.
Yeah.
What's the situation in Eastern Europe? Because I read somewhere that Eastern Europe borrows a lot of money from Western Europe.
On the loan here.
Eastern Europe, in a way, there are two regions. One, a certain part of Eastern Europe they are members of the European Union, but then you have other parts like the Ukraine and some other countries, they are not part of the European Union. So let me talk about those that are in the European Union, like the Baltics, Hungary, Czech Republic, and so on. Estonia will be now the first country. No, not the first, sorry. It will be the third country of these Eastern European countries that will join the euro area, before Slovenia and Slovakia joined the last few years. Eastern Europe was affected by the global crisis like Western Europe. They had big drops in GDP growth in 2009. They are recovering now. It's true that some of these countries, particularly the Baltics, before the crisis, were relying a lot on borrowing from Western Europe. In several of these countries, the banking system is dominated by Western European banks, and they felt very comfortable and expanded credit at too fast a pace. And this added to the crisis. So there was a housing boom, for instance, in the Baltics, very much like what we saw in Ireland or Spain. So this contributed to the crisis. The bubble burst. They had to go through the adjustment. They had big drops in income, but they kept their exchange rate system, and they are now recovering. So it's true what you say, that bank lending was strong from Western Europe. It was actually too strong. And it's one reason or one indication that macroprudential supervision did not really happen before the crisis, because it's a typical example of if macroprudential supervision had been in place already, like we will see it now through the European Systemic Risk Board, this should have been discovered and should have been discussed, and authorities should really have analyzed it and come to the conclusion that credit growth in the Baltic countries was too strong, not sustainable, leading to problems, a typical macro-prudential problem that hopefully in the future will be discovered and stopped earlier. But in a way that's now behind us. These countries have undergone through tough adjustment and they are now growing again. Push again. Push again. No. No.
Push once.
Fantastic. My question, in fact, I've got two questions that are very closely related. You mentioned the first bonds will be issued in January. Do you have any indication yet as to where those bonds will trade? For example, what the yield might be? Will the yield be somewhere between bunds and French bonds? Or will it be a little higher? Will it be a little lower? That's the first question. And the second question is a rather hypothetical question, but I'll ask it anyway. It relates to the provisional AAA rating that all three agencies have agreed to assign to these bonds. There's been a lot of, questions in the media about the ultimate lending capacity of the EFSF, and of course the figure of 440 billion has been mentioned. But my question is, at what point will the AAA rating itself become endangered if the EFSF sees more usage than we're currently expecting? So I guess at some point between 0 and 440 billion, the AAA rating itself might have to be reduced a little. I just would like to hear your thoughts on that. Thank you.
Okay. On your first point, when we issue bonds, we don't know where it will be traded. And it's like bonds issued by any country or big company. It will be traded worldwide. I have talked to around 150 of the largest investors around the world. There's great interest in Europe, North America, and particularly in Asia. Most will probably be taken up in Europe. I think not so much in the US, because the US is running a current account deficit, so they need their own financing. But in countries in Asia and the Middle East where surpluses accumulate every month, there's a need to invest. And the euro is one instrument that they look at. And the EFSF will be a new issuer, a new way to diversify for investors who are looking for high-quality AAA assets. And that's why they are quite interested in this. The yield will be interesting to see where it will be, given that we have a AAA which mainly relies on the AAA countries in the euro area, mainly Germany and France. But we have a few other AAA countries like Austria, Netherlands, Finland. It will be somewhere an average of these AAA countries. We will have to wait and see. It will certainly be a little bit above German bonds, which has the lowest yields in Europe. But I don't think very much, because it's really supported by AAA guarantees or by cash. We will also have a substantial cash reserve, which will be invested in AAA assets. So in a way, the whole operation is supported by AAA guarantees or by cash. I don't think there's a risk that we lose our AAA rating, even if we make full use of our financing possibilities. I don't hope that we have to. But the way the rating agencies look at this is not the one you implied in your question. They look at the guarantee structure, what kind of reserves we have, and whether it's guaranteed that under all circumstances, even under extreme circumstances, bondholders who buy EFSF bonds will always be repaid on time. That's the analysis. And we can guarantee that because we have the AAA countries behind us. We have a cash reserve, so it does not depend on the amount and the size of our operation.
A question.
Can you give us a sense of what will be the size of the first bond
Sorry, the size of the...
Of the bonds that will be selling in January, and will that be only for Ireland because that's the only country that is right now?
Yes, when we do our first operation, we will issue bonds in order to raise money that we will then lend to Ireland. No other country has. Well, this depends on what is negotiated between Ireland right now and the European Commission, the IMF and the ECB. I gave you the overall amount. They will get 67.5 billion euro from in support from the IMF and from Europe. This will be dispersed over a 3-year period, but with substantial front-loading. The numbers are still under discussion, still finalized. But I would assume that when we do our first bond issue, it will be anywhere in the 5 to 8 billion euro range.
A question?
Astrid Dominas from the Lee Kuan Yew School. I know a lot of the drama is in Europe, but I'd like to have you say something about Asia here for a moment. In the situation that the crisis of confidence does not improve in Europe, what are the types of exposures that the Asian countries have? I'm particularly interested in China and Southeast Asia. And when you mentioned the real economy earlier, surely in that sense, there's some real risks and exposures for Asia. Would you comment on those, please?
I'm always happy to discuss Asia. It's sometimes a relief to talk about Asia because everything is going so smoothly here. And we certainly have problems in Europe, but we will overcome them. The world is very interconnected. We know that. And it's getting more interconnected, I think, every year. And it's on the trade side, and it's in financial markets. On the trade side, I think both regions benefit from the good growth again in Europe. Asia benefits from that. Europe benefits from large increases in exports to Asia. So I think that's a mutually very reinforcing and mutually very positive experience. But there are also increasing financial flows, not to the same extent as we have it between the US and Europe or within Europe between, let's say, Germany and Ireland or Germany, Spain. It's not that big. Also, it's important to remember that the current account of the euro area is balanced. So there's really no net, on a net basis, there's no dependency of Europe on outside creditors, unlike the United States, for instance, where every year 4 or 5% of GDP has to be financed by the outside world. This does not exist for the euro area. But of course, there are gross flows between Europe and the rest of the world. There's also a lot of direct investment. Increasingly, China buys companies in Europe. And not only China, also other countries. Singapore wealth funds invest in Europe like they invest everywhere around the world. So they all have an interest that financial stability in Europe is maintained. And they are therefore very interested in the EFSF, what we are doing, how we intend to resolve the issues. I don't see at the moment any negative impact at all coming from these turbulences in sovereign bond markets for Asia. As I said, there's a disconnect with the real economy, which is doing well, and Asia can participate in that. So I think Asia is on a good way to continue to grow much faster than the industrialized world. But also, to put it into perspective, Asia can and should continue for a long time to grow faster than Europe, because looking at China as one example, China has had this tremendous experience in growth over the last 30 years. But even after 30 years of very high growth, per capita income in China is still only 1/10 of the EU average. Singapore is more or less the EU average, but China has a long way to go. India is even behind China substantially. Given that these are the largest economies in Asia, growth in Asia hopefully will be much higher than in the West for a long time to come. So the rise of Asia is continuing.
Thank you. Before I hand over for a couple more questions, let me just turn to, I guess, this issue of the disconnect between the real economy and the financial markets. You've alluded to the upward revisions of EU projections and the like, but presumably the challenge at the moment is within the euro area there's some very big differences in economic performance between the periphery and the core. And it's not just fiscal adjustment, it's getting back the competitive position given the common currency area. Now, in that sort of background, I mean, there's clearly some potential for fragility of expectations. There are sizable, costly adjustments to be undertaken. I guess the question I would ask is, on the one hand, we seem to need commitment in the periphery to make these packages credible. Is there some scope for the center, the core of the euro area, to offset the sort of deflationary shock that's going to come from the adjustments on the periphery?
No, you're right. We have a dual type of economy within Europe. It's not surprising that countries that undertake tough, strict adjustment to regain competitiveness, that these countries either don't grow or even have a decline in GDP. That's normal. When you have to cut incomes to regain competitiveness, GDP will fall. So that's unavoidable. Luckily, the center is doing better. Germany has strong growth, but also other countries in Northern Europe. And don't forget that 10 years ago, Germany was considered the sick man of Europe. So these things go in cycles. It's never forever that one country does better than the others. Or it's the opposite is also not the case that countries that are now particularly weak will always remain weak. Again, look at what's happening in Asia. The countries that were affected so much by the Asian crisis, I already mentioned it, are doing now very, very well. Partly because they took the difficult medicine at the time. So the countries in Europe that are taking now this difficult medicine, they will do better in the future. So at the moment it's positive for all European countries that Germany is growing so much because they are pulling in imports. That in itself is already helping the other countries in the EU, and particularly in the euro area, where trade is not affected by any exchange rate moves. Of course, all countries should always try to do better. Also, Germany could do better in certain areas. This year, nobody will complain with a growth rate of 3.7%. But in general, Germany's potential growth rate is relatively low, partly because the population is shrinking. That cannot be corrected in the short run, but partly because certain parts of the economy, particularly the service sector, are underdeveloped. And certainly when we in the European Union give recommendations to every member state how to improve the economy, there are also recommendations for Germany, and they relate to develop the service sector, to strengthen investment, which has been very low the last few years, and that would help the long-term growth potential of Germany. But at the moment, given the high growth there already, this is helping everybody else.
We've got time for two more questions. I think, like financial markets, we can overshoot a bit. Can you?
Sorry. The question is, you're talking to investors in Asia. Are you trying to interest them into buying your bonds, or to actually help, or would you like Asian governments and central banks to help in the bailout of, say, Ireland, and if the need arises, Portugal, Spain, etc.?
No, when I talk to investors around the world, including Asia, it's to familiarize them with the EFSF, where I am the CEO. We will be a new issue in the market, so people don't know us. They need to know how we operate, how we function, who will guarantee our issuance. It's a bit complicated, like many things that happen in Europe. So explanations are needed. At the moment, I cannot sell them anything because there are no EFSF bonds yet. it would take another 6 weeks or so. But it's important that they become familiar with our operation so that when we issue bonds, they then will decide to take them or not. But I'm not selling anything at the moment.
He will be back, though, to sell.
Time for one more question. There we are.
Hi, can I find out, Shamim from Bloomberg, can I find out who are you appointing, which institutions are you hiring to sell these bonds?
We are going through the process of deciding, but I will not give you any names now.
Well, look, any more questions? We can have time for two more questions.
A lot of overshooting everywhere.
Will eventually undershoot.
Very quickly, Marcus Goswami, I have STI before. Just want to get a sense whether there is some unified policy line on hacking to big trading, or whether it's going one way like the Swiss, where they're incentivizing the buffers, capital and liquidity, over and above Basel, or the other way where there's going to be much more restrictions on how banks go, whether the banks are going to be restricted or not.
Yeah, I think this issue of too big to fail is one of the unresolved issues in the reform agenda of the G20. The G20 at the last summit in Seoul has approved many of the measures that were prepared by the Basel Committee of Supervisors or by the Financial Stability Board in Basel. But the too big to fail, there's no unified position yet. The discussions are continuing. I think everybody realizes that progress is needed here. You are right, the Swiss have moved ahead. It's not clear yet where Europe will come out on this. I think it will be clear that there will be liquidity buffers, and they will probably be bigger for the bigger banks, the bigger financial institutions. But there's no final position yet. The discussions are ongoing in the Financial Stability Board, and it probably makes sense, like in most areas of reforms in financial market supervision, that this is done in a coordinated way so that all the major financial centers do roughly the same thing.
Thanks. We have a question.
My name is Declan McFadden, and I lead a APAC division of a German company here. As you can hear from my accent, I'm certainly not German. I left my homeland well before the Celtic Tiger was born, but I still stay in contact, and I'm stunned by the activities that I've seen over the last number of years. And I'm equally stunned by the bailout of these institutions that was led by what I would call either incompetent or corrupt management. And I can understand what you said earlier on, the reasons for doing this. But I hasten to add that these institutions were funded by PSIs, as you call them, who either knew or should have known what was happening, that this was unsustainable. So while I understand the practical reality of not wanting to shut these banks down, I could only support it from the point of view that the end game must be the eventual shutting down of some of these institutions and rationalising the number of banks operating there. Would you agree with that?
Well, looking at the Irish banks, many things went wrong. You know that coming from the country. If you want to know a lot more details, I did a report for the Irish Parliament analysing why the crisis hit Ireland so much, and this focuses mainly on the banking sector. There was also fraud, and we know that. That's the history. So now the question, what to do? Two of the main banks have been nationalized already. Another one is partially nationalized. And as part of the support package that was adopted by the Euro area finance ministers last Sunday, the program proposed by the Irish government, an important part is the restructuring of the Irish banking system and the deleveraging, so downsizing of the Irish banking system. There's a detailed plan. I cannot talk about the details now, but I think in a few years' time there will be certainly fewer banks in Ireland than you see today.
Good.
One very
final one.
Very brief. You said that things tend to overshoot, and is there any fear or any indication that you get right now that your own program will overshoot the 440 billion that you want to now paper right now? And also the first tranche of bond that you expect them to be as far as Europe, or
You mean on bonds that I issue, or I didn't get the second part of your question?
First, one second, you said on exactly, will they be only, since you're starting a board, will it be only sold in Europe or will it be sold all over the world?
Well, I already answered that question. These days, you never know where bonds end up. They are traded globally. Maybe one aspect I had not mentioned, we will first issue in euro. We can also issue in other currencies, but initially we will certainly do it in euro because our lending is in euro. But it doesn't exclude that at a later stage we could also issue in other currencies. So 440 billion, which is the sum of the guarantees that supports the EFSF, is sufficient to deal with all the problems that I can see at the moment.
Well, look, thank you very much, Klaus. I think a realistic, optimistic message in terms of a stronger euro area in the medium term, where in a sense, rather than go towards high levels of fiscal centralization or financial sector oversight, you have decentralization there, but better coordination. And the challenge will obviously be to develop the mechanisms to get the required degrees of coordination in that type of system where we have decentralized fiscal policy and decentralized financial sector supervision at the micro and macro level. But look, thank you very much, and we'll be observing developments in the euro area and the potential for these important reforms to strengthen the system. Thank you.
And I may come back and keep you up to date.